Hi everyone, we're going to kick this webinar off in just 1 minute's time. All right, let's kick off in 1 minute. Thank you. All right, let's kick this off. Thank you very much for taking the time to attend this webinar. Today we are going to discuss scalping strategies in currencies, in FX to be precise. We're going to go over some fundamentals of scalping for those of you that are interested in becoming scalpers, which is very short-term trading in the FX market. If you can't hear my voice, to your typing functionality, your chat or text functionality, and I'll be able to see if you're experiencing those problems, and I'll try and solve it. So the agenda for today is to discuss price action versus mean reversion. These are the main two types of markets that you would encounter as FX traders, and also where scalping tends to work best, in which specific market. We'll give you 4 effective tips or steps that you need to take in order to scalp effectively. And then I always like to discuss some trading dangers that are specific to scalping, because it's a very high frequency trading type of alternative. It's very important that you understand what dangers await in the market. And then last but not least, we will have a Q&A session. If I've missed anything during the webinar or you have any questions outstanding, I'll be happy to address them there. One key thing to note is that, again, after the Q&A, should anything remain unanswered, this is recorded and you can get in touch with your and guide you forward. So this is Tickmill, a little bit about the company. It has a long-standing brand. It is regulated in certain jurisdictions. It provides a good trading environment, and it operates in over 100 countries. I am required by the law to read you this disclaimer, so please bear with me. The contents of this material are provided by a third party and not Tickmill, and institute investment. I assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Tickmill unless otherwise specifically stated. Currency trading may not be suitable for all investors, as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading, and seek advice from an independent financial advisor if necessary. So there are 2 primary ways the markets will manifest themselves when you are trading them. Whether you are a short-term trader or extremely short-term trader that is looking for hourly positions with a view to capture maybe 10 pips or 15 or 20 pips, which is what scalping is known as, or if you're a long-term duration trader, which takes positions over a day or a few weeks or a few months, the markets generally come in 2 main modes. One is the trending market, the one that is driven by liquidity and normally event-driven. So a news event or a macroeconomic variable creates a trend. Now, trading in the direction of the trend is wiser, it's smarter, it allows you to get better entries, and also, since there's a lot of liquidity behind it, there's a lot of consensus behind it. Whether it's a bullish trend or a bearish trend, it's a safer environment to trade in. And you can scalp in this environment as well. However, generally speaking, this is a more tricky environment to identify because you don't know when the trend is going to end that easily. And mean reversion is the more common type of manifestation of the market. Markets tend to be range bound more than they do trend. All right, so we're going to explore how to scalp in both types of market conditions today. And it is absolutely imperative that you first and foremost classify the market in one of these two types before you endeavor to trade it. All right, just jumping in and then expecting for your trades to your long or short positions to work, hoping that the market reverts to a mean or becomes a trend is a recipe for long-term capital ruin. So the first and most important step in our view is to actually identify what type of market it is that you're focusing on right now. All right, whether you're using kind of 5-minute charts or 10-minute or 15-minute or hourly charts, the key thing is to identify, is the market ranging, which is effectively the price, a currency or the currency pair is moving between a particular support level and a particular resistance level. Now this could be S1 and this could be R1. And as you know, for those of you that are new to support and resistance trading, there are typically 3 support levels, each progressively more difficult for the price to break through and progressively further apart in terms of pips than the current price. And then there are also 3 corresponding resistance levels, each progressively difficult to break and also that much far apart. All right. And the key thing to note is that in a ranging market, you're basically going to get price meandering between the lower Bollinger and the upper Bollinger band, or the lower support and resistance levels. In a trending market, the price will effectively move in what is known as impulse waves, and then these micro corrective waves, where there's a small correction, normally all the way to the moving average, followed by a larger move up, creating a higher high. And these waves can come in waves of 2, 3, or 5. And then when the market reaches some degree of overboughtness, then you can start to get exhaustion signs setting in, and then you get a downtrend in corrective waves as well. The key thing to note is you want to pick, do you want to be a scalper that is focusing on range-bound markets that are not driven by news flow, possibly in the quieter periods of the market when London is closed, or do you want to be trading during the actual European day or the concurrent EU and US session where these markets are trending heavily, normally news flow driven? Both types of scalping are possible, but the key thing to note is that they are different animals entirely. All right, so scalping in a ranging market is uniquely different than scalping in a trending market. So how do we do it, right? Getting right down to basics, effectively, let's say it's a ranging market. The key thing you need to do is identify your resistance levels. R1 I've drawn here, and then S1 would be here. The support is always below the current price or below the current pivot level, and the resistance level is above. Okay? And depending on your risk appetite as a scalper, this will also determine where you would deem fit your entry points, your long or short entry points. All right? If you are a low risk trader, you would completely disregard the first line of resistance or support, and you would maybe focus on S2 and R2, or possibly even S3 and R3, like we saw today with the British Pound USD hitting S3, hitting R3, which is the most difficult resistance to break. This totally depends on you. The key thing to note is that if a price hits R3, it is more likely to revert than if it just hits R1 or R2, right? So progressively, it's difficult for the price to get to a high resistance level, but when it does, it's likely to revert, and therefore it's a more stronger short signal in that respect, or short indicator. So let's say you want to become a range trader, or you're looking for range-bound scalping opportunities. It's as simple as effectively placing your long position, all right, opening a long position, and obviously set your leverage. We'll discuss your leverage settings later, and also the lot sizing and how many lots you purchase. But right now we're just going to talk about directional trading here. So you would effectively open your long position somewhere when the price actually hits your support level. Let's say you're looking to go long, right? So let's say you're seeing the prices bouncing between the range. When it touches your support level, you would open a long entry, all right? Alternatively, as a scalper, you may wish to wait for the price to hit your resistance level, your R1 or R2, and then you would take a short position with the view that the price, when it hits the resistance level, will experience some degree of pullback or a micro correction or a retracement. All right? And it is this small drop after hitting a resistance point which is effectively scalping, because this drop will normally be anywhere from 8 pips to 15 pips, kind of in that range. It's very unlikely that you are going to, within a period of an hour or 30 minutes or some short duration, capture 30, 50, 60, 70 pips, unless you get a very sharp reversal after hitting a very significant psychological resistance point or support level. Most likely what's going to happen is the range-bound trading will follow waves within these support and resistance levels, and you'll be able to capture anywhere from kind of 8 pips to 15 pips in that kind of range. And that's effectively scalping, right? So you're going into a ranging market, you're waiting for the price to hit a significant support or resistance level, and you're betting in the opposite direction, trading in the opposite direction. We will get to stop loss management and take profit settings in a bit. All right, that's the most important part actually of scalp trading. But right now, all I'm showing you is how you trade a ranging market. Okay. Now, key thing to note is you're probably wondering, okay, which support and resistance levels really matter? Well, realistically speaking, if you go to Google and you type in daily support and resistance levels, there's a lot of FX blogs, a lot of prominent places where you can get daily free, live updated, technically calculated or mathematically calculated support and resistance levels, right? There are 4 types. The most important ones are the floor trading levels, the ones used by the floor traders historically, and these are the classic SNR levels that everyone kind of mentions, and they are effectively the last period's open, high, and low close pricing. They are priced off of that, right? There's also Camarilla support and resistance levels. We're not going to spend too much of this webinar discussing the different type of support levels, but what I will say is that just use the floor levels. They're the most used ones by most traders, and therefore they're also the ones that tend to have the most self-fulfilling prophetic nature about them, right? So because a lot of these are psychological in the end, although they're calculated mathematically, it's all psychology here, we would suggest you stick to the normal floor trading SR levels. Now, in terms of which ones matter, in terms of what time frame, absolutely the ones that matter are the hourly support resistance levels, the 4-hourly support and resistance levels, and the daily support and resistance levels. When I'm looking for my scalp opportunities, I'm typically, I'm focusing on 4-hour charts and daily charts, because those support resistance levels actually are quite good at repelling price. Right? And this is assuming that there is no major ECB news or non-farm payroll news or some significant macroeconomic news that could scupper your trade, right? Because I'm trading range-bound trading, I'm making sure there is no news in and around when I enter my long position or my short position and when I close out my position, capturing hopefully some pips, right? Now, so in answer to any questions surrounding what time frame you want to be looking at for your support resistance levels, it's typically the hourly levels. You don't want to be looking at minutely charts or 5-minute support resistance levels. They don't carry too much validity. Go for the 1 hour, 4 hour, and daily support resistance levels that are calculated. Okay? That's ranging trading, right? So you effectively open a position when the price hits a point of resistance or support. Again, I'll reiterate, if you have a lower risk appetite, then you don't have to wait for you have to maybe forego entering a long position when the price hits the first point of support and wait for it to hit the second point of support. Remember, when the price hits the first point of support, there is statistically a risk that it will pierce and break that support and head to the second support. And that purely depends on the size of the buyer or seller, as in the size of the position that is being taken, because sometimes it can be so big that it actually cracks the support, leading the market to believe, oh, it's actually a major headline or news that's driving the price down. And later on, the market finds out there was nothing really there, and then the price reverts strongly. So for those of you that are lower risk scalpers, you may want to actually get in at the second line of support, which is S2 or S3. All right. Just I'll briefly pause what I'm saying. I'm seeing a few questions from one or two people. I'll take questions definitely towards the end, and I'll answer all of them. Okay? And let's discuss trend trading now. All right, so this is how you would open and close positions in range trading. In trend trading, there are a few things you can do. The safer way to scalp amidst a trend is actually not to enter it when you witness the breakout. For those of you that trade with Bollinger Bands, you know what a classic diverging Bollinger channel is. When the candle has broken out, the hourly candle or the 30-minute candle has broken outside the upper or lower Bollinger, and the Bollinger Bands are diverging, they're looking in different directions, and the moving average is trending up and the price is moving up. You could enter the trade then, especially if you've identified the news or the event that has caused the trade to happen, for the price to actually move up, right? In that case, you could open an immediate position and scalp it up to whatever is the next logical point of resistance. So let's say this was R1 here, the price resistance to, in terms of pips. That's the higher risk form of scalping a trend. The lower risk form is actually wait for the first corrective wave. Remember, when a trend begins, it doesn't just end after one wave up. There will be one wave, then there will be profit taking. It's in human nature to lock in gains. And this corrective wave will normally last until the moving average, which is also known as the middle band, or the moving, or the middle Bollinger Band, right? Or for those of you that are plotting SMAs, simple moving averages or exponential moving averages, just wait till the price corrects until there, and then that is where you would open your long position with the view that the price will resume its original course or its original trajectory or path up to the next point of resistance, whether that's R2 or R3. Depends on your risk settings and, of course, the event that's driven the breakout and the trend. But the key thing to note here is that the safe entry is to actually wait for the first wave to expire, to collapse or correct, and then enter somewhere near the moving average with the view to capture this move here, these pips up. Okay? And that's effectively how you would scalp a trend. Now, one small danger in scalping trends, and I mentioned this at the start of the webinar, is that trends do end. They do not continue into perpetuity, and when they end, the market effectively could correct and reverse into a counter trend, or it could just move into a ranging pattern. Now, a ranging pattern is safe because you can deploy the same strategy that I mentioned earlier at the start of this slide, which is just to go long and short when the price hits support and resistance respectively. But if you are looking to get into, let's say you've missed this entire trend, right, for whatever reason, but you're getting excited now and you want to trade this trend, be mindful of the fact that when the markets move up in a trend or down a trend, they move in waves of 3 or 5, right? This is classic Elliott wave theory principle, which is not too applicable all the time, and it's sometimes overhyped, but it is very important to note that whether you believe in Elliott wave theory or not, that's almost irrelevant. What is important to note is that the price moves up in waves, and the waves don't always last forever. So if you've missed 2 or 3 powerful waves, I would prefer that you just let the trend then subside and move into the next ranging formation and trade the ranging formation, then try to get on late. All right, you want to catch these trends sort of earlier on, all right, maybe after the first corrective wave or the second corrective wave. So again, going back to the first and most important step, it's effectively identifying the market and acting accordingly. It's so important that you classify whatever you're looking at right now in the market in either a ranging or a trending one, because that will determine how you actually open your long or short positions. And to some degree also how you're going to be setting your take profit and stop loss levels. And this is what we're going to briefly touch on next. Okay. So the key thing to note is when you are trading a range-bound market, right? When you are trading a price that is moving within a specific Bollinger range or support and resistance range, when you open, let's say the price hit support level S1, the question is where do you set your take profit level, right? And where do you set your stop loss level? Okay. And the third question you're probably going to have is, do you use trailing stop losses, which are dynamic stop losses or dynamic stop loss management, where the stop loss actually moves with you as utilized position comes into the money, right? And the answer to the first part of these questions is effectively you want to set your stop loss relatively tight, all right? Because ranges can break very quickly. Ranges are there to be broken. Markets like to explore new territory. So once the market is broken, it's probably going to head in that direction, especially if it's driven by news, and you don't want to have a naked stop or no stop loss. So let's take a fictitious position. The price is hit here, support 1, and you open a long position, right? You want to set your stop loss probably at S2, which is the second support level, which I have not pictured here, right? Or I think I could possibly draw it. So let's say this is S2, right? And this here is S1. So you want to set your stop loss here. And let's say that is 15 pips away. Just for argument's sake, that's 15 pips away. So your stop loss, sorry, let's say 10 pips away. Let's say it's 10 pips away, so your stop loss will be 10 pips. That's the maximum you could lose in pips, okay? And your take profit level should be typically between 1.5 and 2 times your stop loss level in pips. And the reason behind this is you want the trade from a risk-adjusted standpoint to be in your favor, right? Your risk-reward ratio should be 2 to 1, in that range, 1.5 to 2.1. You don't want to be willing to sacrifice 30 pips, right? Having a wide stop with the view just to scalp 5 pips. That may work in some instances, leading you to believe that you have some newfound money management system, but long term, a risk-reward ratio of less than 1 actually hurts your capital growth through time. So be very careful with not adequately setting your take profit and stop loss levels. We would always suggest a multiple of 2, roughly in that range, okay? So if your stop loss is 10 pips away, your take profit level should be 20 pips above your entry price. All right, and again, if you're going in from loss, it would be maybe 10 pips or 8 pips, and your take profit maybe 15 or 16 pips, in that kind of range. Now, what if you are actually scalping in a trending market, right? Where do you set your stop loss and take profit level? So where you would set your your stop loss level in a trend, actually, the good news is that it's going to be pretty tight, even tighter than a range bound. The reason behind this is, let's assume that you actually waited, you were conservative, and you waited for the first corrective wave after the breakout happened, let's say 20-30 minutes ago. You waited for the first correction, the price hits the moving average or comes near the moving average, you start to open 1 or 2 long positions here, right? Equal lot sizes. And once you've opened them, your view is that the price will at least head up to the previous high. And that is where I would set your take profit level so that you can capture this pips, how much ever pips that is, hopefully 15 to 20, right? And thereafter, any profit you make is excess profits, which you can do by moving up your stop losses to the minimum profit level that you want to extract in this trade. And anything above that is just excess profits, which is great for you, right? But effectively, we would place your take profit level in line with the previous high, right? And your stop loss level, now here's the interesting thing, your stop loss in this case can actually be quite tight. What I haven't drawn here is a lower Bollinger Band, but this is effectively how a lower Bollinger Band would look in an upward trending range. And the price would typically be scratching the upper channel, or the upper Bollinger Band, and this here in the middle is the moving average that you see, right? And generally speaking, how it works in the trend is the price touches the upper channel and then it comes back down and surfs the moving average and goes on up and then surfs the upper Bollinger channel and then comes back down, and it continues this wave until which point it runs out of steam, right? That could be a few hours later. With regards to you setting your stop loss levels, you can actually set them just at the lower Bollinger Band, somewhere around here. If your entry was here, okay, you can set your stop loss just at the lower Bollinger Band somewhere here. Okay? And the view behind this is that in the odd event that this is a fake out, it's a fake trend, it's just a large buyer, it has nothing to do with news, and the market wants to get back into its range somewhere here where it was before, you don't want to be hit by that, right? Or worse coming, what if the market reverses itself completely? You want to make sure you don't participate in that drop, because that's going to hit your pips. So you just set your stop loss at the lower Bollinger Band, which is a good support level. Another place where you can set your stop loss level is the previous resistance, right? So let's say this was R1 over here. Okay, this over here, this yellow line that I've drawn here, I'll just draw an arrow to it. Let's say this was R1, right? This line here. The price broke out of it and it created this upward trend, right? Thereby turning this resistance level into a support, right? That's one of the properties of support and resistance trading, is that what is previously resistance, if it's firmly or decisively broken, it turns into a support level. And therefore you could set your stop loss here, right? Or whatever the equivalent price would be. So somewhere here. And your entry on this position will be somewhere here. It's kind of neither here or there, whether you want to set it at the lower Bollinger or here. Roughly speaking, they will coincide. In the event the lower Bollinger Band is actually diverging and it's looking downward, then you don't want to set it at the lower Bollinger, because that's a very wide stop. So go for setting it at the resistance point. Okay? This might be a lot to take in, but it's actually simpler than it really looks. The key thing to note is setting your take profit and stop loss levels is easier in range-bound markets than it is when you're scalping trending markets. Okay, so that's the meat of the webinar. Now we're going to go over some small steps and additional measures you should take in order to optimize this process. So firstly, please pick the most suited trading instruments, right? This is a near live bid-ask spread from your Tickmill trading panel. And you want to basically go for pairs where the cost of entry when you're entering your positions is very low, right? So unless you guys are using ECN accounts where the spread is near zero, generally speaking, these are the type of spreads you will get when you're entering trades. For example, gold is a high spread asset, so it's about 13 pips. You don't want to be scalping on gold because it's going to cost you 13 pips just to get in. But you could scalp on the Russell 500, or you could scalp on the Euro US dollar with almost no spread, or the British Pound USD with a tiny 1.2 pip spread, right? But if you're going in for 7 pips profit and the cost of entry is 3 or 4 pips, it's, you're shooting yourself in the foot. From a risk return ratio, that's just not a smart pair to go on, right? And this brings me to the point of news. During news or going into news, just avoid scalping, because what's going to happen is the brokers will normally ratchet up these spreads even on your majors, on the major pairs. So go for the low spread pairs. And this also has a bearing on liquidity. So the most major pairs like the Euro US dollar, British Pound USD, Australian dollar USD, and US dollar Swiss franc, these pairs, they have more liquidity than the exotic pairs, which means that they tend to possibly, when they range or when they trend, the trends actually last longer, whereas and also the difference between price points is more granular as opposed to the heavy volatility that comes in the bid-ask prices when you have these very low liquid pairs. So we would again suggest you to scalp and stick to majors. Let's talk about time frames. It's very important for you to calibrate your charts correctly. So obviously I haven't put it on here, but definitely add your Bollinger Bands. They will help you. And we would suggest you doing a multi-time frame analysis. It's very important that you triangulate 30 minutes, 1 hour, and 4 hour charts. Also 1 hour, 4 hour, and daily resistance points, support and resistance points. And you just keep switching between 30 minutes, 1 hour, and 4 hour charts to actually find out, is the market trending or is it ranging? Right? The classification part of scalping, which is what we discussed earlier, can only be properly done when you're doing multi-time frame analysis, which means you are effectively moving between charts, right? Toggling between the 3 different types of charts. Now, whether it is 15 minutes, 1 hour, and 30 minutes, 4 hours, this is purely a comfort choice for you. I personally use this 3, but you can use more suitable time frames for you if you've had better progress with those. As for actually positioning your trade, right? Some traders would like to zoom in just to make sure they get a better timed entry. right? So if you zoom in or you drill down into a 1 minute or a 5 minute chart, just to time your entry on the moving average for a long position, let's say in a trending market up, sometimes it helps to look at a quick, shorter time frame chart, right? Some of you probably use indicators. There are two types of traders, those that trade without indicators and those that use a lot of indicators. And sometimes in between you get a few that use just the basic ones like RSI or some sort of oscillators. I personally don't use any of these really apart from Bollinger Bands, but you may want to use moving average crossovers to confirm a change in trend. Whether it is a change in a corrective wave like this amidst a larger trend up, and effectively you want to know when this corrective wave will end, you could effectively wait for the SMA, the simple moving average, to cross a higher period EMA from below, right? And that would potentially signify a reversal of the micro correction and a resumption of the overall trend up, right? So you could use moving average crossovers if you want to. It's absolutely not required in order to generate capital or growth through scalping, but you can use crossovers as well. You can use relative strength indices and stochastic indicators, which indicate overbought and oversold levels over certain points, again, to time your entries, right? Again, if for example, you were trading this range-bound market and the price hit S2, right? Let's say it broke through S1, it hit S2, it hit somewhere here, and at the same time you saw the price leaving oversold territory in the RSI indicator. It was oversold already all the way going into S2, and then it actually started to leave. This is known as Rsi Divergence, where the price is showing something else when compared to what the indicator for price is showing. That indicates a reversal is possible, right? So you can definitely use these overbought and oversold indicators. And then, of course, Bollinger Bands are very important because they allow you to place your stop loss levels to some degree. And also, if you study Bollinger formations, which we teach separately as well, it gives you a good indication of whether the market is range bound, if it's trending, if it's breaking out as well. Okay, so you're optimizing using indicators. By no means is any of this necessary, but you can do so if you like. And then very important, of course, is determining your risk levels, right? So please, definitely, if you want to scalp, make it a regimen. Determine your risk and reward targets per trade in advance, right? Just understand that today, okay, the markets are a bit trendy or range bound. Maybe today I'm going to keep a risk reward ratio of 3 times or 4 times. Always make more than you lose, or aim for that. That's what the greatest traders do. They let winners run and they cut losses early on losers. And we would, again, I'd like to reiterate, keep a risk ratio of 2 to 1 or higher. Typically that would be a take profit of 15 to 20 pips and a loss of 5 to 10 pips. One thing to note, and I did forget to mention this, is, but while we're on topic, in a ranging market, you can go for a higher risk reward ratio because once the trend is started, you can move your dynamic trailing stop losses and move the stop losses up automatically or manually and keep kind of capturing in and locking in gains and profits, and this process can continue. So we would suggest you going for a higher risk reward ratio than 2 to 1 for your trend scalps as opposed to your ranging scalps. I would say that this is all great if it works for you, but let's say you experience drawdown and you take a few hits. We would suggest never ever wager more than 1% of your total equity on any particular trade, right? So if you have $10,000 in your FX account, we would suggest that don't let any trade make you lose more than $100 on any particular trade, because scalping is high frequency, so you're going to go into the market multiple times, possibly 1 or 2, 3 times per day, and certainly 5 to 10 times per week if the opportunities are there. This is how scalpers trade. They're high frequency traders. So you don't want to subject your capital to 2 to 3% each time, because suddenly you could be sitting after 1 week on a 15% drawdown, and that's difficult to recover from mentally sometimes. Okay. And last but not least, overall, on a daily basis, if you have experienced more than a 5% hit, it's probably time to throw in the towel for the day and go and do something else, because then you may engage in revenge trading, and that's very risky. In the event that you caught in losses, please don't martingale, right? So for example, it is very tempting that, let's say you were too early to get into this trend here and you didn't wait until the moving average, and you bought one lot here, and then the price moves against you and you buy another lot here, and the price keeps moving against you and you're doubling up and you're buying 5 lots and suddenly you're buying 10 lots. And the risk is that the market could change its direction, leading you to suffer very, very substantive losses. And we would suggest that you don't martingale or double up your positions. Scalping doesn't work that way, right? You need to control your losses. So your stop loss setting is much more important than actually generating pips at the expense of leverage trades. Okay. What you can use is dollar cost averaging, which is effectively using the same amount of lots. So let's say you would have bought 5 lots of the British pound USD when it hit a certain point. Instead of buying 5 at that point, you can actually just buy 1, and should the price move against you, buy 1 more, and it moves against you, buy 1 more, up to a certain point. If your trade thesis is still intact and the trend is still up, let's say, and you're going long, then you can build smaller positions, equal dollar size positions, equal amount of lots, thereby subjecting in total the same amount of lots you would have done at one price, the 5, but you're just doing slower, and this is known as dollar cost averaging. Okay, but don't confuse this to martingaling, because the two are distinctly different. This is used by professional fund managers. This is used by gamblers. And last but not least, with trend scalpers, people that are trading trends, you can make more money scalping, more movement, but please be careful that trends can persist only for so long, and they can be fake trends, and when they break, they could turn into a counter trend. And there you need to make sure your stop losses are in place. Do not ever remove your stop loss, because then you're effectively hoping. And I can tell you that the market that you're facing, has about 4 to 5 trillion in liquidity every day. And it can remain trending in one direction against you longer than you will stay solvent, right? Because none of you has a $100,000 account. And even if you do, that's not enough. The liquidity that you need to actually influence the market otherwise is enormous. So you as a retail trader need to understand that when you're getting into a trend, keep your stop losses tight. And then following on from that, let's discuss some scalping dangers, and dangers that are generally found in the FX market as well. There's a lot of scalping EAs, right? I'm not allowed to mention for legal reasons which ones, but those of you that have looked into the expert advisor market, which is effectively robots or algorithms, those that are generally priced to the lower range or free, they are risky. In my personal experience, I've lost money with them. Do not fall for it that easy. Use it on a virtual account first if you have to. Okay. We would definitely suggest that you trade these scalps or use a scalp trading strategy using technicals. Understand the technicals that we've gone over today. Fundamentals are important for duration traders, but scalping is a very technical strategy. You cannot really scalp just based on your knowledge of fundamentals. All right. Then there's news. News is the one single big thing that can destroy and trigger all your stop losses very quickly. So if you're going in for scalping, range-bound scalping, trade around the news, not going into it or after it. If you are trading trending markets, then wait for the news to happen, for the trend to be established, wait for the first corrective wave, like I showed you earlier on, and then build your positions, either long or short. Okay? And then last but not least, of course, spreads, right? We mentioned it briefly earlier on in an earlier slide. Spreads are very important. They will impact your ROI, because as a scalp trader, you're going to go into the market again and again over time. You got to take a 1-year view on this. You can't expect to make a huge gain in just 3-4 weeks in FX. So pick and choose your really well, because some of them will have higher spreads attached to them. Okay. Now on the spreads point, quick point on Tickmill's competitive offering, you have ECN accounts which basically have zero spreads. Typically Euro-US dollar spreads are at 0.2 pips, which is competitive. The commissions per trade are fractional, and you also have obviously low minimum deposits. The leverage size, this is obviously contentious. Although Tickmill does offer 500 to 1, we would obviously suggest for you, those of you that are new, stick to very low levels of leverage. There's no point in leveraging up dramatically. The best traders in the world don't use very, very high levels of leverage. You have the ability to purchase these micro lots at 0.01, and the trade execution is quite fast. All right. So that was the webinar. And I hope that was informative to some degree. I'm now free to take some questions. I already see some questions. I'm sorry if I didn't answer them during the webinar, but I'm very happy to take them now. So I see a question here. Do you trade live, for example? No, Hamid, we do not. These webinars are purely instructive only. Do you look at a chart on a single time frame or multiple? So use H1 for SR levels and entries on M15. Tim, that's a good question. I got a question from Tim. Absolutely. So what you're referring to there is multiple time frame analysis, MTF. Certainly you would look for SR levels on larger time frames, and for entries you can use 30-minute charts, 1-hour charts, or even 15-minute charts. That's the right thing to do. And most certainly not, Tim, multi-time frames is not just confusion, it is important. I see a question from Dillian Suriachi. How can you identify the trend changing point? Dillian, you can use the trend changing point. You can use indicators like the MACD, right? The moving average convergence divergence indicator. You can use moving average crossovers. You can also look at Bollingers, right? Bollinger Bands. When you see a hummingbird formation in the market, which is a traditional formations which means that a large trend that's moved up may start to correct, that's a formation as well. Generally speaking, when a price, let's say it's rising and it hits a significant point of resistance, let's say R2, R3, the risk of a reversal, assuming there's no major news, is quite high. So you could, if the price is starting to show signs of exhaustion, such as candles that are showing shooting star patterns, bearish haramis, or things like this, for those of you that know Japanese candlestick analysis, these signs of exhaustion in the market, even on shorter time frames, are good indicators that the market is getting exhausted, especially near a resistance level or support level. So that should be giving you information that you're going to get a reversal soon. For those of you that watch Elliott wave theory, or that listen to or abide to Elliott wave theory, you know that the market moves up in waves, right? Waves of 5 and it corrects in waves of 3. So if you're late on a trend and you're in the 4th or 5th wave, it's likely there's going to be a correction shortly. So a question from Laszlo Komka. How much lot size do you recommend on a 1K account? Laszlo, good question. The amount of lots depends on the currency pairs. It purely depends on that. What I would suggest is on a 1K account, you want to make sure that you're not, because a 1K account is very small, I won't say that each trade should be 1% of your account, because that'll be a $10 loss, and that's very, you're not in FX to make $10. My suggestion is that you should keep it to about $20, $30, so 3% of account, right? And you should therefore purchase that many lots such that when your pips, if you were to trigger your stop loss, right? Let's say your stop loss is 15 pips, such that the damage on your account is, let's say, $1 per pip, so that you only lose $15, if that makes sense. I can see here that Mike has answered Laszlo's question. Yep, that's fantastic. Question from Lang Jun. Did the meeting time start before 40 minutes? Yes, it did. I see a question from Doman Edvard. Are long-term strategies more profitable than short-term strategies? Doman, it totally depends on your risk appetite. So if you take a long-term strategy, then the more longer your positions, the more you have to factor in news events and macroeconomics, right? If you're trading Euro US dollar, scalping it today, you don't really care if the US goes on an interest rate tightening cycle, right? Or if Greece leaves the Eurozone. Today, it's probably not going to specifically impact your scalp trade. If you're taking a 3-month view and you're going short the euro US dollar, you have to get clued up on what's happening in Greece. You have to get clued up on what's happening in the US. Now, if you get those right, yes, long-term trading will be more profitable in terms of number of pips, because if you're going in for a 3-month position or a 1-month position for whatever reason, you have to have much wider stop losses, a few hundred pips, but your take profit level therefore also has to be much larger. So you're probably going to capture more pips. See a question from Tim Nama. How do we get a recording for this webinar? Tim, it is recorded by the Tickmill staff, so you should be able to access it. Yeah, to anyone who's asking that question, it's get in touch with your account manager. Any other questions, anybody? Thank you, Dylan, for your kind comments. It's very kind. I'm glad it added some value to you. Question from Rumen Petrov. What if you get a great setup, but no matter how you look at it, there's no way to get to RR2, but you get RR1? Will you skip the trade? Statistically, if you are right more than 50%, you will still be a profit in the long run. Yes, Rumen. I think you answered your own question. So if you get a great setup and there's no way to get to RR2, but you get an RR1, you don't skip the trade. No, absolutely not. So if the setup is so promising and you have a history of getting risk-reward ratio trades of 1-1 right, again, this is so important for those of you that are using the Kelly risk criterion to allocate your percentage of equity per trade, right? That's what the Kelly risk formula does. It looks at your historical win rate, and it also looks at your historical profit factor, which is a direct function of your risk reward on your trades. If you are winning a risk reward of 1-to-1, if your win rate is over 55% or 60%, as you said, 50%, you'll make money. But if your risk reward is 2-to-1, let's say, or 3-to-1, your win rate only needs to be 40% or 30% or whatever, if that makes sense. So the question, the answer to your question, Rumen, is how good are you at winning these 1-1 trades consistently? If you know what I mean, because FX is a long-term game. You're not going in here for 1 week in order to make a killing like in gambling and then come back out. You want to make a career out of this. So if you can consistently win 1-1 trades, then you're absolutely fine as long as your win rate is above 50%, right? Or 55% after costs. I see a question from Stefano Bagliocchi. What is the right setup for a stochastic indicator? Again, it depends on your time frames, Stefano. Scalping, I have it on my charts. I rarely use it. It's basically 9 and 1. Or for those of you that have 3 parameters, 9, 1, and 1. So 9 periods. So a question from Mike Frisbee. Let's say you have a TP and a price comes to 80 to 90% of your profits in range there. Do you close it or wait and risk profit? Mike, you close it. If it's at 80 to 90% of your take profit, you close it. Worst coming, you can move up your stop loss to a certain level so that no matter what, you have profit on this trade, but maybe just not as much. But if you're at 90% of your take profit target, you probably want to lock in the gains, right? Any other questions, anybody? Ruben, great question. I do pad it a bit because price tends to overshoot support and resistance levels. It doesn't respect it perfectly. So I do pad my stop loss levels. Roman is basically asking if you pad your stop loss levels or take profit levels by a few pips around the resistance and support levels. And I personally do pad it. But the padding shouldn't be as big as the next resistance level. Yeah, sure. Thank you, Vladimir. Andreas, your question on Bollinger Bands, what is the best setup for these? That's an interesting question. So for range-bound trading, I would say 14 periods and 2 standard deviations. And for trend trading, you can also use 14 and 2, but I tend to use a slightly more relaxed setting of 20 and 2, 20 to 25 to 2. Also, it depends what time of the market you're trading in. So if you're trading after 5 p.m. GMT, when 50% or 60% of volumes are no longer there because London has gone out of the market and Asia is out of the market. So it's mainly only USA that's trading after 5 p.m. GMT. At that point, I would need to go for a more sensitive Bollinger setting because some of these resistance and support levels or the lower and upper Bollinger Bands just won't be met by the price. So I won't be able to enter my trades. So it depends on the time of the day. Any other questions, anybody? Yes, Yugoslav. The webinar is now over. We are in the Q&A Q&A session. Sure, Andreas, no problem. I'm glad you found it useful. Mike, you're asking, do you know when Tickmill will allow EU traders? Best way to get that answered is get in touch with your account manager or just write to support. Same answer to you, Vladimir. Best to get in touch with support at Tickmill. They will be better able to guide you if and when they will accept EU traders. Ruben, good question on fibs. So we use Fibonacci's in a very particular formation. It's known as the dead cat bounce. That's after the price has dropped very heavily during a day or risen very heavily during the day, and it faced a sell-off at night, a corrective trade, and we pull out the Fibonacci retracement patterns and we draw a Fibonacci grid to see until where the price could retrace to. Normally, I would set my take profit level in a short trade somewhere at the 21% retracement point. But I haven't discussed Fibonacci here today, although it's certainly a very valid thing to use. I see a question from Doman Edward. What's my favorite indicator? That would be Bollinger Bands, Doman. Andreas, your question on do I have different Bollinger periods for 15 and 1 hour and 4 hour charts? No, absolutely not. I keep those static. Ruben, you're asking if I use Fibonacci's for fading? Correct. Tim, your question on hedging instead of stops. So the thing about stops is there's no cost of entry, but with hedging there is a cost associated with the entry, depending on the pair. So mathematically you have that against you, and the problem with hedging also is that what if you get the hedge wrong? What if the price goes against your original trade, leading you to believe that you should hedge, but then it actually goes back in the direction of your original trade once you hedge? So you could get stuck in this vicious cycle. But it's worth trying it. I know hedging works very well during explosive news events. You can go long and short before certain news events if you time that right. Again, this is not investment advice, but this is something that many traders do. But I'm not too sure about hedging during a scalping scenario. But that maybe could be just because I've not done it. I'm not saying it doesn't work. It's if it works for you, you can certainly try it. Okay, do I see any other questions from anybody? Ruben, yeah. So in a trending market, if you want a lower risk trade, it's not to say you only would trade the second wave, but I guess the point is that the market, like with anything in life, it goes up not in a straight line, right? It moves in waves. Anything that goes up needs to come down eventually. And when there's a firm trend established, it's very rare when you just get one large pronounced wave and then the price comes down, right? You're going to get these micro patterns where the price comes down to find supply at the moving average and then goes on to make a higher high. And you want to play that second leg or possibly a third leg. In the first leg, the risk here is that what if it's just a false breakout, right? And so it might never hit your take profit level, and before you know it, the market is corrected and your stop loss is hit. So I just view the first impulse wave as confirmation or precedent being established. Then I know, okay, a trend is there, and then I just enter at the moving average. Any other questions, anybody? Ruben, good question. Yes, I personally only trade red news or high impact news. Ruben is asking a great question. There are actually 6 news events that one should be trading. I won't get into them right now, but a lot of them are, for example, consumer price inflation, CPI, which impacts directly interest rate appetite and interest rate rise and dropping appetite, and of course consumer confidence and jobs numbers, jobs data. You know, these are kind of key things to trade. The medium impact news is iffy, and certainly the low impact news is just it's should be avoided. Mike, yeah, there's a lot of news trading websites that track that information. Economic calendars show that information in real time when it's coming up, so you know when to avoid the news. Mike is basically asking if there's a place where you can know where, you know, when news is coming out so that you don't get stuck in it. Yeah, hundreds of places. You just have to Google it. Thank you, Ruben, for your kind words. Will we be teaching the news trading seminar? Most likely, I think we will. I personally have, I love trading fundamentals. I love trading the news. So that's more what I focus on. I'm not so much a scalper myself, so to put it. I'm more a duration trader. So yeah, definitely, I think we'll be going over the news trading very shortly. Great. Any other questions, anybody? Okay, I see no other questions, so I wish you a great trading day ahead, and I will see you all very shortly.